Hello, everyone. Today on the final bar, my guest is Sam Stovall from CFRA Research. Sam, it'll be great to have him back on the show. Giving a bit of a take here as we get very, very close to the elections. Think about where we're at right now, where we're at heading into year end. Today, sort of a follow up on the last couple of days after yesterday, earlier in the week, the big sell off. Here we have a bit of a stabilization as we chop around that 3,400 level, which is literally the midpoint in the 3,200 to 3,600 range. I think that's where we're at for a little while, but we'll see what the charts can tell us about the potential future direction. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we make sense of these markets together through the lenses of technical analysis, behavioral finance, macro strategy, quantitative methods, whatever we can do to try to build and enhance our understanding of the market environment. You know, it's interesting to see a sort of a choppy day. Usually call a day like this a digestion day. After you have a big move, usually think about, some digestion period where you sort of digest the meal and then you figure out what's going to happen next. And there are plenty of themes to tease out today. One of the key tells today, I would say, would be the weakness in mid caps and small caps. The S&P down about 1/3%, mid caps and small caps down about 1% more. And I think that speaks to some of the internal weakness might not be as prevalent on the chart of the S&P. It's not encouraging for the short-term market going forward. We have a lot of guests to help us make sense of this sort of range-bound, choppy market environment. Sam Stovall from CFRA Research joining us today. Tomorrow we have Jeff Greenblatt from Lucas Wave International, big cycle guy. So it'll be interesting to hear, the cyclical relationship to what we're seeing right now. And then on Thursday, Dana Lyons from J. Lyons Fund Management. Dana was on the show in late January and had some very prescient comments about an overextended market, put call ratios, and just glancing back to what we talked about then versus now, I'm seeing some similarities. I'm interested to ask Dana about that. Also coming up very soon on the 29th, we have the pitch. This is our regular broadcast where we have three strategists come in and pitch you their ideas. What are their best investment ideas right now? And this time we have Mark Newton from Newton Advisors, John Kosar from Asbury Research, Aaron Swenlin from Decision Point, and our own Grayson Rose is going to be moderating that discussion. The pitch is a lot of fun, and you're going to leave with a list of tickers you jot down on a piece of paper to dig into. So it's really worth checking out. That's on the 29th, called The Pitch. Let's get to our market recap. We asked you a poll question starting over the weekend. We have a poll going on our StockCharts TV page at all times, so check it out if you missed it before. And this was a bit of a knowledge check. I said, know your technical indicators. Which indicator does not imply price direction, but simply measures the strength of the underlying trend? And I have to say, I almost stumped Final Bar Nation here with this one. 36% of you missed it and said RSI. The correct answer is the 40% of you got it right. ADX, the average directional movement, relative strength, 18%, parabolic SAR. So RSI, relative strength, which is the stock versus a benchmark, and the parabolic SAR system, which is a RSI and the SAR system, and the ADX line are all created by Wells Wilder in the 1970s. And he wrote a book on technical trading system that outlined all of these and has his handwritten commodity pages where he calculated the levels by hand every day. But RSI, relative strength, and the SAR system are all built on directional movement. It tells you where, the trend. So a high RSI means the stock has gone up a lot. A low RSI means the stock has gone down a lot. The ADX line is actually very different because it's average directional movement. The higher the ADX line, the higher the trend. It doesn't tell you what direction. It just tells you that the trend is strong or the trend is weak. So a lot of people design systems where a high or a low ADX line are one of the inputs, because that would tell you, are we in a trending environment or a range-bound environment? If you miss that, or if you don't understand that one, check out our chart school articles on the ADX line. It might be something you want to pay attention to because it's helpful as a sort of a building block to a basic technical process of evaluating a chart. Let's get to continue with our market recap. As I mentioned, the S&P down below 3,400, closing around 3,390. What's interesting, I think the real story today is the weakness in mid caps and the weakness in small caps. If you look from the open, it was pretty much just going further and further down. So mid caps and small caps, we sort of saw a continuation from yesterday's sell-off. S&P not as much. S&P sort of chopped around. So, in terms of a takeaway, that feels like more weakness under the hood. Now, given, again, the S&P closed at the lows of the day, but small and mid down as much. The reason why the S&P didn't go so far down, you can see the S&P 100 actually finished flat on the day, and the NASDAQ 100 up 0.8%. So this is a narrow group of names that outperformed. Communication services, technology obviously represented highly in the NASDAQ 100. The average stock was sort of down here, trading lower, and the average mid or small stock had another rough day today. So again, I think that it's sort of a traditional topping sort of experience where you have small number of bellwethers doing well. The average stock's starting to struggle a little bit. Bonds were stronger through the course of the day, up 0.2%. Yields going lower around 78 basis points. Oil up pretty good, but energy stocks not doing so great. They were down 1.3%. Gold still chopping. We talked in one of our 3 and 3 charts yesterday. So we're this range bound experience for the GLD. Let's go there very quickly, and then we'll get to the chart of the S&P 500. We talked about gold being sort of in this sideways trend, and the GLD, you can see the sell-off into the low in late September. Since then, really hasn't gone anywhere, and the RSI is almost to the penny at 50, right? It's at 50, which is literally an equilibrium of up and down days is essentially what that means, an absence of momentum, if you will. So until the GLD is able to get above its 50-day moving average, above the Fibonacci retracement level, push it up around 181, it's telling you it's just not the time yet. This is essentially a sideways trend. It's reached the correct value versus, in terms of where investors think gold should be. No direction yet. John Bollinger would say, you wait to see which way. It doesn't necessarily say higher. You wait to see which way this breaks. Does it break out to the upside? Does it break down to the downside? And the direction of that momentum, whichever side takes control, you'd expect that momentum to continue. That's sort of a traditional low volatility to increased volatility take on the GLD. So I think the next step is going to be pretty key. Now, the daily chart of the S&P 500, we've had this purple area, and one of the viewers wrote in and said, Dave, I think you need to call this the purple haze zone because we're confused and sort of chopping around in this purple shaded area. I did not intend that, but I love it. So we are literally back again in the purple haze here below 3,400. We've talked about 3,350 to 3,400. That's this first sort of key level of support. And again, that lines up with the August peak. Lines up with this chop around in September. We're now once again, so this is a congestion area. This is an area where we spent a lot of time here. So very reasonable that we would that we would find support here, that this would be an objective. And literally it's the midpoint between the lows just above 3,200, the highs just below 3,600. We're really at 50% of that range. I wouldn't be surprised if we spend some more time backing and filling, going into the elections. You could see some further downside retesting the 3,200 to 3,250. I would expect that to hold based on the support we found here back September. So my base case, and again, a base case is fine. I have to tell you, this is not a prediction, and something different could happen. I would immediately want to adapt it. But I could see us sort of backing and filling in this range for a couple weeks, and then you resume higher to finish up more toward the highs, given the traditional strength in November and December. But we'll see. We'll have to see what happens. Certainly, the internals suggesting some weaker movements going into the next week or two. Interesting to see financials, industrials at the bottom of the list. The industrial sector is a sector that has emerged pretty well and had some really good charts in there. Certainly seeing some weakness today. Financials as well. We talked about JP Morgan yesterday, and I think, a sector like the XLF, what it does relative to, key long-term support, the fact that it broke above the 200-day moving average and now, as of today, has closed back below it. So it's really failed there. The fact that it wasn't able to eclipse its highs from August and September. The chart at JP Morgan we looked at yesterday, similar, but in this case had not gotten above the 200-day, just for a day or two, and now has reverted right back downwards and following through today on yesterday's sell-off. So you have charts like that could be emerging higher and are not able to do so. And I think, again, that's not an ideal situation for some of these financial stocks, for sure. Further down here, Ben, this is Franklin Templeton. That's down one of the biggest losers today in terms of their scooter rankings. And again, these particular movements, if stocks are one of the biggest scooter gainers or the biggest scooter losers, the chart obviously doesn't tell you why Franklin is down. It will tell you how much it's down, and it will tell you where it's gone to. And I think with a chart like Ben, it's helpful to look at the chart. Again, the chart did not anticipate this sort of move. This is obviously something else that causes the stock to be down 13, 14% around now. It's a lot of earnings. It's a lot of M&A activity. Those are the sorts of things that would move it. But it is always valuable to look left on the chart. What I see with something like Franklin Resources is we're down at the lower end of this support area. This is where the stock has found support. And so it's not unreasonable. The anecdotal evidence is investors that bought here are happy with the price coming back down to the valuation level that clearly they felt pretty good about a month ago. You could assume that that buyers might come in and add to positions there and provide further support to it. If not, and if you start breaking through 19, that's when you have to be concerned and think about the potential for further downside and what that might mean for you. But it's interesting, again, on a big move, a lot of times these big scooter moves will tell you which charts to start to look at. The news and the fundamentals are what can tell you other things about what's actually happening there. One final comment, just interesting to see a couple of groups here at the top. 3 of the top 4 are in materials, including gold miners up 2%. Gold as an asset not moving a ton, but gold miners doing pretty well. Again, the reason why the market's doing so well, the internet group, which is a lot of market cap and comm services, the software group, which would be Microsoft, computer hardware is Apple's group. These are the groups that are doing pretty well today. This is why the market holding up okay and not selling off like we saw in mid and smalls today. That is our market recap for today. We're going to take a quick break. Back with my guest, Sam Stovall. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we love to hear from you. We're going to do another mailbag segment a little later in today's show. We'd love to answer one of your questions on the air in our next mailbag segment at the end of the week. You can get your questions to us 3 ways. One is via email, thefinalbar@StockCharts.com. The second way is on Twitter @FinalBarSCTV, or on our YouTube channel. Just put a comment below one of our shows on the video there, and we'll capture all of those, hopefully answer one of your questions in our next segment, our next mailbag segment at the end of this week. I want to welcome on our guest back to the show, Sam Stovall from CFRA Research. As I've mentioned, leading up to this show the last couple of days, I love talking with people like Sam who come with a methodology, built-in macro strategy and other things, because it's always helpful to relate what he is seeing to what we're seeing on the charts. Sam, welcome back to the show.
Happy to be here, Dave.
So obviously there is a somewhat important election coming up in the U.S. All eyes are sort of thinking about what the potential direction would be and where we might be headed. You starting us out here with a table of looking at some of the presidential elections past. Talk us through what you're seeing here.
Well, the presidential predictor that I've been talking about over the last several elections says if the market goes up from July 31 through October 31, then the incumbent tends to get reelected. And this predictor has been correct 82% of the time, failing only in 1968 and 1980. If the market, however, has gone down, then the implication is that the incumbent will be replaced. And that has failed only once, and that was in 1956. So people ask me today, well, Sam, with Biden leading by 8 to 12 points, does that imply that the presidential predictor is wrong? Or like 2016, when Hillary Clinton was up in the polls, does it imply we are going to be surprised? Well, first off, we're not at October 31st yet. The way the market has gone yesterday and today, it could be pointing downward, implying that the president will be replaced by the Democratic challenger. If we do get a Democratic victory, even though the market is higher, I tend to look back to 56, 68, and 80, looking for geopolitical disruptors. In 56, it was the Gamal Nasser seizing control of the Suez Canal. It was the Hungarian uprising. In 68, it was the Vietnam War. And in 1980 was the Iranian hostage crisis. So this time around, I'm thinking it's COVID taking more of a hold on the market than the election itself, because stocks tend to focus more on economics than on politics.
That's such a great chart. We had a panel on the presidential cycle last week, actually, and I love this take because, you know, I feel like looking at cyclical patterns and what's tended to happen a lot of times is helpful to think about how right now can compare to some of these previous cycles. That's a great outline of where we're at relative to some of those previous elections. Now, obviously, we're pretty overheated in terms of the growth trade, and I've heard about the return of value a number of times. It hasn't tended to materialize. What can you tell us about this growth versus value trade here?
Well, this chart is showing a rolling 12-month differential between the S&P 500 growth and value. So in the past 12 months, growth has exceeded value by 34 percentage points, which is the highest in history going back to the start of the mid-70s. So even higher than where we were in the late 1990s, implying that, yeah, this is a concern. With very, very low interest rates, investors have been gravitating toward growth to the point where I'm very concerned. S&P 500 growth PE ratio right now is trading at a 70% premium to its average over the last 20 years. Wow. That said, value is only trading at a 25% premium. So I look at this chart and I say the reason growth is doing well is because interest rates are so low. The old Fed model where you take earnings for the S&P 500 over the coming 12 months, divide that by the Moody's investment bond grade yield, and basically says, okay, the S&P should be trading at 4,200, a 23% appreciation over the coming 12 months. The only question outstanding is, what if rates go to zero? Then, that stocks can go to the moon. So this does imply to me it's above 2 standard deviations from the mean, that like that old Milwaukee beer commercial, it just doesn't get any better than this.
Beautifully said. Now, your third chart, we're looking, Sam, at the CAGR, the compound annual growth rate for the S&P 500 rolling over the last 10 years. Walk us through this one.
Well, what this is just says, okay, can we really expect double-digit gains in the next several years as we have over the prior several years? And the answer is, I don't think so. There's no guarantee when it comes to the markets, but on a rolling 10-year CAGR basis over the last 100 years, we essentially have had peaks. 1929, 1959, it would have been more consistent if it was 1999, but it ended up being in 2000. And then we had a 14.1% compound rate of growth in 2019. It doesn't mean that the market is going to exhibit the glide path of a crowbar and then instantly drop into negative territory. But I think what it says to investors is adjust your expectations. If the average is a gain of about 6% over the last 100 years, and we're still above 1 standard deviation of 11.2, then don't expect double-digit increases over the coming years. Readjust your sights and be happy with mid to upper single-digit gains over the next several years.
Sam, that's a fantastic take. Those are 3 great charts to share with us. Hope you and those around you stay safe, and I look forward to talking to you again soon. I
look forward to it. Thank you, Dave.
Sam Stovall from CFRA Research. I love the perspective looking at, and again, when you think about the, where we're at, sort of the mean reversion with some of these themes, growth versus value, just the return on the S&P, right? The growth rate on the S&P, and looking at where we're at and how we're extended on the upside or the downside, it shows you where we're at relative to those historical trends and what we might want to be thinking about for the coming weeks and months. Great chart from Sam Stovall there. Our next segment is the Final Bar Mailbag. As I mentioned, we love to hear from you, particularly the questions that you run into. We see part of what we can do for you as part of the show and part of StockCharts TV is just answer questions as you're navigating these markets. Let's get to some of your questions from the last 24 hours or so. Question number one, Dave, I saw on Twitter a little debate about what would be the two indicators in addition to price you would choose to have on your charts if you could only have two. Just curious as to which two you would choose. Ooh, I love that question. Okay, so I can't choose price. That's obviously a given. If I had to choose two, I would probably say, that's such a tough question. I would say moving averages, and I would group them as one. I would say, the set of moving averages, I'm going to cheat and call that one indicator, which would be moving averages. And then I'm torn between these two. You can see this is the default chart that I have, which is price with moving averages, with RSI, and with the stock relative to the benchmark. And to be honest with you, those are the ones that I use most of the time. I guess if I had to choose two, I would do moving averages and I would do the relative strength because the RSI is helpful. You really can tell when something's overbought or oversold based on the price action itself, I would argue. So if I had to lose one, I'd use those, and those would be the two. Moving averages to smooth out the price movement, look at long-term trends, help you think about support and resistance levels, and then relative strength. If I had one thing, it would be relative strength because in general, buying stocks where that line is going up, you're going to do better than if not. Really good question. I'd love to ask everyone that comes on the show that same question. Term number two, Dave, can you do a segment on how to quickly find stocks in a similar sector, such as oil equipment? And you were looking at this stock in particular, TNK, which is in oil equipment and services. So, what I would love to do is have a way to go right from this chart and look at those, look at that peer group. I'm actually talking with our development team about doing that within the ACP platform. So you have a chart up, we can feed some of that data into a side panel potentially and do it. The way you do it now, though, is if you go, and there's a couple ways to do it. So maybe the easiest way is on your member dashboard. So if you click on your dashboard, in the upper left, you have member tools. Scroll down a bit and you'll see this guy called Industry Summary. I use this page a lot. I usually do it on table view, but this will give you just a quick visual. I usually do table view because I find it's easier to find them. This is by sector. I'm grouping them. It groups the groups within each sector. So when I come down to energy, you can see the different groups. I see oil, equipment, and services. Click on that and you can sort it by market cap. You can sort it by scooter ranking. I use that a lot to find, what's working in different groups. Always poetic when chart industries is the number one sector or number one stock within oil, equipment, and services, pun intended. Next one, let's see here. Oh, I had a comment about the chart for Cisco, and I put this chart up, and when I put it, someone made the comment. I had said, look, the stock's going down, it's making lower lows, lower highs. I think, in general, that's the type of chart I want to avoid. I said something like that. And Charles Dow would say pass on this. And one of the comments I got, the exact opposite could have been said here, where where it was a big buy, right? Where it's making higher highs and higher lows. It's above moving averages. So if it didn't work there, why should I assume that this is a sell here? So basically, it looked really bullish here. It didn't really work out. And so the short answer is absolutely right. Stocks making new closing highs. Now, again, we can nitpick about, boy, did it really get above the previous high? Maybe not. But overall, I feel pretty good owning this type of chart as it's above two upward sloping moving averages. The fact is, on this day, that picture changed very much. And so, I think the point of charts is a couple things. Number one, it's obviously not going to work 100% of the time. None of the things I'm ever going to show you on the show work 100% of the time or anywhere near that. I wish that were the case, but what I've learned from working with a lot of institutional investors, you don't have to be right all the time or even anywhere above 50% of the time. You just have to stay with it when you're right and get out of it when you're not right. And so if you're buying here and the chart gaps down and starts going lower, at some point there, you have to agree that that didn't work and that the new high didn't work and that it's now in a downtrend. You need to cut your losses and start thinking more on the downside. So the good news is the chart will tell you very quickly when it didn't work and when you're wrong. And I think the key is making sure that you do it. So absolutely right. The conditions were much more positive there. No, it did not work. And I hope that you would follow what we talk about to, make sure that you unwind that as quickly as you can to make sure that you save your capital. This is a long question, so I'm going to summarize. I use 4 different methods of analysis combining different indicators. I find Ichimoku charts to be one of the most helpful, not only for trend analysis, but for keeping me out of trends that are likely to stall or reverse quickly. My question is, none of the contributor stock charts seem to use or mention Ichimoku. Why is this? Why is this when it's such a popular and helpful technical analysis tool? If you're not familiar with, a lot of people call it cloud charting. And it's basically here under overlays. You can go down here to Ichimoku Cloud. I'm going to add this one. It's going to add a bunch of stuff to the chart, so sorry for that. This is a Japanese form of technical indicator, and I've spent time on Japanese trading desks, at Japanese banks where all they use are cloud charts and candle charts, and that's it, and seem to have a lot of success with it. What's interesting about cloud charting is it basically takes open, high, low, close, it smooths it out a little bit and actually projects it 26 days into the future. So one of the few technical indicators that actually shows you a future path and shows you expected resistance or expected support going forward. So that's one of the things that people like about it, is if you would rally, it gives you sort of an area at which you might expect resistance for Cisco. And there are a bunch of different ways you can use this, as in, is it break above through the cloud? Does it, where is it at relative to the cloud? You have these other things called the conversion line and the baseline. Are they, crossing up or down? There's all these different ways that you can actually use it. I found it actually very helpful. For simplicity, I don't tend to have it on the chart along with everything else. And I found that if my goal is to understand trend, I think I can do that with things like moving averages and other techniques, but you could easily replace some of that with the Ichimoku Cloud and actually do very well. There are some people that use it more than others. Katie Stockton from Fairlead Strategies come to mind, Mark Newton from Newton Advisors. And when we have them on the show, I'll try to remember to ask them to include a cloud chart on there so you can just see how they use it. But it is very valid. And again, I've spent time with some of my Japanese friends that swear by it, and it's hard to argue with their conclusions. Next question. You mentioned on one of your shows scanning for 3-month price highs and 3-month relative highs. I know how to scan for new price highs in stock charts, but how do you scan for 3-month relative highs in terms of price relative to the index? So the short answer is we can't do it. I've talked to the development team about some of the ways we can try to do it. So you can look at the changes in the relative strength as maybe the closest proxy, which is one of the scans that I have. But overall, I tend to look for 3-month breakouts in relative strength in my normal manual chart review. So every week I go through, a couple hundred some charts and look particularly for those patterns. The new scanning engine is something that's been on our list for a while. It's something that's in development. It's going to take quite a while to get it right, but that's certainly one of the things that I guarantee we will include in there. Thanks for that question. That is our mailbag. Again, those are all questions from you guys in the last day or two. Really appreciate you sending your questions in. Keep them coming, and we'll get to as many as we can. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is sort of a look at breadth. I mentioned earlier about the weakness in small caps and mid caps versus large caps. I'm not showing you the cumulative advanced decline lines, but I definitely am going to want to look at that at the end of the day once that breadth information locks in for the close, because I have a sense that it's gotten weaker for mids and smalls in a way that might be an interesting tell. The McClellan oscillator is a good way to look at breadth within the large cap space, and this is looking really at New York Stock Exchange, so it's a broader universe than that. It went below zero back here in mid-October. It's been a day above it, but back now below it. And again, when the McClellan oscillator is below zero, it tells you to tilt more negative than positive. It's just the smoothed out breadth readings are getting more negative. So that remaining below zero would certainly, at the very least, tell me limited upside for stocks. At worst, tell me that there's much greater potential for further downside. Chart 2, another play on breadth. This is looking at percent of the S&P above their 200-day. We're still around 70%. Stocks above their 50-day moving average, which were really close to that 50% level. Last time we broke below 50% was back in here in September. That usually means sort of a short-term choppy period. And in brief pullbacks within uptrends, a lot of times 50% is the place to look. If we break down through there, and even more so if we break down from the percent above their 200-day, that would tell you to think about potential for steeper, deeper, longer declines. We're not anywhere near that yet on the percent above their 200-day. The 50-day, though, getting more and more negative as the days go on. Finally, this is the telecom index, $XTC. There are a couple ways we look at telecom stocks. This is just one that I've used for a while. What's interesting is we've pulled back to support from late June. That's also at a Fibonacci support level. This is AT&T and Verizon. AT&T is one of the worst stocks within communication services on a technical basis. This tells me that we are either nearing a short-term bottom. We break that, I think there's potential for further downside there. Folks, that is our show for today. Thank you so much for joining us. Special thanks to Sam Stovall from CFRA Research joining us from New York. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.